There are three buckets of lending in Canada. Bucket number one is for your clients who can basically get a mortgage anywhere, and that would be your major banks and credit unions. Bucket number two is what we call B lenders, or lenders that they know or they do massive exceptions to the five areas that a lender will look at. Like a major bank will look at the property, down payment, income, credit history, and assets and liabilities. If one of those buckets doesn't work, then a B lender will get you a short-term approval for, let's say, 1 or 2 years until we can solve the issue and transfer that client to the A lender or bank or credit union. And there's a third bucket, which is what I called investment funds. A lot of brokers call them private mortgages. I don't call them privates because, in my opinion, it's way better to go to an investment fund than to go to a private individual. Private individuals are emotional, and that usually end up costing money to the end borrower. When you go through an investment fund, it's just a business like anybody else, so they're not emotional, so the fees and the rates are standard and even a little bit below market. So that's bucket number C, which is investment funds, which is even higher rates and fees, but they're meant to solve a specific problem while we can solve the issue and bring them back into the B or A buckets. I hope this helped.